Jordan picks stocks. Real research. Real conviction. Apple, Microsoft, the next big thing before it's big. Casey does the opposite. One fund. Same amount every single month. Never reads an earnings report in their life. Same age. Same job. Same paycheck. Same starting line. 30 years later, one of them retires with almost double the money of the other. And it's not the one you'd guess. The one who did nothing wins by more than $500,000. Not because they got lucky. Because of a number Wall Street has never put on a billboard. A number that explains why almost every professional stock picker on Earth, with research teams and Bloomberg terminals, still loses to a fund that makes zero decisions. By the end of this video, you'll know that number. And you'll never look at your own portfolio the same way again. Let's be fair from the start. Picking stocks is not stupid. Owning Apple, owning Nvidia, owning the company you believe in, that is not a foolish thing to do. Feels active. Feels smart. Feels like control. But here is the problem with feeling smart. Markets don't pay you for feeling right. They pay you for being positioned correctly on the right stocks for the entire ride without flinching. And almost nobody does that. Not amateurs. Not professionals. Not because they're bad at investing. Because of how stock returns are actually distributed. We're going to show you exactly what that distribution does to a real portfolio over a real lifetime in real dollars. Jordan and Casey are both 28 years old. Both earn $65,000 a year. Same city. Same job level. Same monthly investment. $600. Jordan builds a portfolio of individual stocks. A dozen names. The big tech companies, a couple of growth bets, one or two, nobody's noticed this yet, picks. Hours every week on research. Earnings calls. Charts. Conviction. Casey buys one S&P 500 index fund. Same $600. Every month. No research. No thesis. Just buys the entire market and walks away. At a dinner party, Jordan has stories. Casey has nothing to say. One of them sounds like they're winning. We're about to find out which one actually is. For the first 2 or 3 years, Jordan looks brilliant. One pick is up 60%. Another up 40%. Jordan brings it up constantly. Proof the strategy works. What Jordan doesn't bring up. The position sold at a loss in year 2. The one quietly still down 30%, just sitting there, unmentioned. Casey has no stories. The index fund just goes up, slowly, with no headlines attached to it. On Jordan's mental scoreboard, the wins remembered, the losses buried. Jordan is winning. On the actual brokerage statement, where every gain and every loss counts the same, Casey is already quietly ahead. That's not a flaw in Jordan. That's how every human brain handles money. You remember the trophies. You forget the receipts. Here's the part most people never hear. A well-known study out of Arizona State looked at every single public stock traded in America going back to 1926. Tens of thousands of companies. The finding, a small sliver of those companies, somewhere around 4% of them, produced essentially all of the stock market's total wealth above what you'd have earned just sitting in safe government bonds. The other 96% of stocks, as a group, barely matched that bond return or lost to it outright. Read that again. Almost the entire return of the stock market came from a tiny handful of extreme winners. Everyone else was noise. Casey owns all of it. Every single one of those rare winners from day one of trading automatically just by owning the whole index. Jordan owns 12 stocks. Even picking well, even picking blue chips, Jordan still has to land on the next generation of those extreme winners by name in advance and hold them without selling for 30 years. That's not a strategy. That's a lottery ticket dressed up as a strategy. And it's not just amateurs who lose this game. Every year, S&P runs the numbers on professional fund managers. People paid full-time to do exactly what Jordan does on weekends. Over a 15-year stretch, the large majority of those professionals, with research teams, with Bloomberg terminals, with MBAs, still lose to the plain index. If the pros can't reliably win this game, Jordan's odds on a Saturday morning are worse. If you've made it this far, this next part is the one that actually moves the number. There are 3 leaks in Jordan's strategy. Each one looks small. None of them show up as a single line item. All 3 run quietly every single year for 30 years. Leak 1, taxes. Every time Jordan sells a winner, takes profit, or rotates out of a loser, that's a taxable event. Active portfolios like Jordan's typically turn over a large chunk of their holdings every year. Casey's index fund barely turns over at all, and what it does turn over is handled efficiently inside the fund. Over 3 decades, that gap alone can cost tens of thousands of dollars in taxes Casey never pays. Leak 2, behavior. Real investor data shows the same pattern again and again. People sell winners too early. They hold losers too long, hoping for a comeback. They panic during crashes. None of that is a character flaw, it's just what a human brain does when real money is on the line. But it has a cost, and that cost comes directly out of returns. Leak 3, concentration. Remember the 4%. If Jordan's 12 stocks happen to miss most of that 4%, the portfolio isn't just unlucky. It's mathematically starved of the only thing that drives long-term stock returns. None of these 3 leaks feel dramatic in any single month. Run them for 360 months in a row, and they stop being small. Let's put numbers on it. Same $600 a month. Casey's index fund tracks something close to the long-run stock market average. Call it 10% a year. Jordan's portfolio, dragged down by taxes, behavior, and concentration, runs closer to 7.5%. That's not a wild gap. That's a realistic one. At year 10, Casey is around $123,000. Jordan is around $107,000. A $16,000 gap. Barely visible. Jordan isn't worried, the account is still going up. At year 20, Casey is around $456,000. Jordan is around $332,000. The gap is now over $120,000. Still feels survivable. At year 30, both at 58 years old, ready to retire. Casey, roughly $1.35 million. Jordan, roughly $808,000. The gap, over $500,000. Same income, same monthly contribution, same 30 years. Jordan never made one obviously bad decision. Jordan just made the same small mistake 3 different ways every month for 3 decades. To be fair, stock picking isn't pointless. If you genuinely understand an industry, you're an engineer who reads chip research for fun, or you work inside healthcare and actually understand a drug pipeline, that knowledge is real. It's called a circle of competence, and inside that circle, the odds shift in your favor. Inside a Roth IRA or 401k, the tax leak disappears entirely, so picking stocks there costs you far less. And treated as 10% of a portfolio, just for engagement and learning, individual stocks are completely reasonable. The problem was never that Jordan picked stocks. The problem was treating stock picking as the entire retirement plan, in a regular taxable account, without ever running the math. Zoom out and the pattern is simple. Index funds win on tax efficiency. They win on cost. They win on capturing the rare winners automatically instead of trying to predict them. And the professional data backs it up year after year in fund after fund, across decades. None of that means Jordan is a bad investor. It means Jordan was playing a game that statistically favors almost nobody who plays it that way, including the professionals who do it for a living. Casey didn't win because Casey was smarter. Casey won because Casey owned the 4% without ever needing to know which 4% it was. This was never really a story about stocks. It's a story about 2 different questions. Jordan asked, which company is going to win? Casey asked, how do I own the winner without having to guess? One of those questions feels exciting. The other one actually builds wealth. The market doesn't reward conviction. It rewards exposure to the right tail of a very lopsided distribution, and the only guaranteed way to own that tail is to own everything. Same income, same effort, same 30 years. One number, quietly compounding in the background, decided which life they'd retire into. Jordan felt smarter the whole way there. The math never agreed. See you in the next one.